Well, good morning. Today is Tuesday, November 18th, 2025, and there's so much to talk about as markets around the world are just under pressure. So let's go. And so first I want to say, refer back to my note yesterday when we talked all about the momo traders, because that's just alive and well this morning. Stocks around the world are lower. Right? Tech bond sales are now the new concern on top of everything else, apparently. Bitcoin goes negative on the year at one point this morning. Gold is down, oil's down, and bonds are up. Now, you got to ask, is this the flush before the year-end rally? Well, we'll find out. What do we have at dinner tonight? We're going to have the Tuscan beef Peposo. We'll talk about that in a moment with a little bit of history. Okay, so buckle up because it is risk-off around the world. Stocks, Bitcoin, gold, all getting slammed. Bonds, though, are higher. Global markets are lit up in the red. In Asia, they hit the sell button really hard. Japan down 3%. South Korea down 3.2%. Taiwan down 2.5%. Australia down 2%. Hong Kong was down 1.7%. And China, well, that was the winner, only down 0.6%. And across the Eurozone, it's the same story this morning. Pressure everywhere. Italy down 1.5%. Spain down 1.4%. The Euro stocks, right, down 1.5%. France down 1.1%. Germany is down 1.1%. And the UK, well, they're the winner over there. They're only down 0.8%, right? Less than a full percent. And here at home, the tone is no different. U.S. futures are lower across the board, setting us up for another down day here in the States. The slide is not a surprise. Right? And so here we go, because we've talked about this. This is so long overdue, and nobody should be shocked or panicked by it. Call it a slide, call it a reset, call it a shakeout, pick your word. But in my opinion, it was just coming, right? I thought we'd see it in September, October. Remember, I talked about it all summer. It just took the market a little longer to catch up with reality. Now it appears that now it's here. All the things that we've been talking about are finally starting to hit home at the same time. Stretched valuations, tech especially, right? The upcoming non-farm payroll report, which is, causing some angst. The next OFMC meeting, which is, just weeks away. The start of the big retail earnings is today, and the countdown to Nvidia earnings on Wednesday night. What's funny, though, is that none of this is new. We've been saying this for weeks. That stocks are stretched, that the NFP could disappoint, that the Fed is confused, and that the consumer is wobbling. And that the AI bet has been priced like it can never miss. The new obsession? Big tech and bigger debt. And now here's a fresh concern that the media is latching onto this morning. In essence, creating even more concern for investors. Yesterday, Amazon sold $15 billion worth of a 40-year investment-grade bond. The original expectation was for $12 billion, but there was $80 billion in demand for this paper. That's 7 times oversubscribed. What that means, it's a massive amount of money looking for a home, right? Too much money chasing too little supply. On its own, that shouldn't really be an issue, but layer on top of recent deals from Meta, they raised $30 billion, Google raised $25 billion, Oracle raised $18 billion in debt markets, and suddenly the narrative becomes big tech is loading up on debt to finance the AI infrastructure, CapEx, and maybe buybacks, right? So is this sustainable? Now, let's be clear. These companies are cash machines. They're ATMs. We're talking about combined free cash flow north of $200 billion a year and trillions in market capitalization. Their supposed issue is that analysts now fear that shifting from self-funded AI to debt-funded AI, and they're waving the red flag, trying to draw a straight line right back to the dot-com bubble where hype completely outran reality. To which I'd say this is not the dot-com bubble 2.0. Anyone trying to compare today's AI build-out to the late 90s dot-com mania needs to have their heads examined. Back then, we had businesses, and I quote that were nothing more than websites with Super Bowl commercials and no revenue model and no products. Today, we're talking about companies like Nvidia, Palantir, Google, Amazon, Microsoft, IBM, AMD, and others that are generating real cash, building real infrastructure, and serving real demand. You cannot compare Pets.com to Nvidia. You can't compare a sock puppet to a $1 trillion platform running global compute. You can't. And if you want to make that comparison, then you need to go back to your Ivy League school where you got your education and get your money back. Because this is not 1999. But, and this is important, even real stories can get overbought and real companies can trade at ridiculous prices when the momo crowd takes control. And we've been discussing this for months. And now the market appears to be adjusting. Now let's make sure to discuss leverage another day and the impact that that has on days like today. And I mean margin leverage and ETF leverage. And to think, they're trying to create ETFs that are 5 times levered on top of that. Think what that would do to the market on a day like today. It's just mind-boggling to me. Anyway, what's funny now is that all the guys that kept saying, oh, there'll never be another down day on Wall Street, are now the very ones who are saying, oh, this is completely appropriate. You guys are killing me. Anyway, yesterday, stocks ended the day lower. Dow gets clocked, down 557 points. The S&P gets whacked, down 62 points. The NASDAQ got slapped, down 192 points. The Russell got punched in the face, down 46 points. The transports got kicked in the gut, down 265 points. The equal-weighted S&P suffered a blow to the chest, down 100 points, while the Mag 7 got a slap on the wrist, only falling 35 points, or less than 0.1%, right? Which was crazy because all the other ones were down better than 1%. Now, the momo guys are bailing, and that triggers the algos to follow suit. When an index fails to hold a trend line because the fast money crowd is running for the exits, the next step is always the same. Lower prices. Technical chart failures, right, breakdowns, automatically cause the algos to go into sell mode. Conversely, technical chart breakouts cause the algos to do the exact opposite, right? So when trendline supports are broken, that's a failure to hold. The algos push deeper into sell mode. And the buyers, they just step aside, right? They watch how panicked the sellers are going to get. And remember, let's be clear. Stocks don't go down because there are no buyers. There are always buyers because for someone to sell a stock, someone has to buy the stock, right? So there has to be somebody willing to buy it. So don't let anyone tell you that there are more sellers than buyers. That's a misnomer. What we actually have is more aggressive sellers, which allow the buyers to step aside and be patient. They're selective and they become much more price sensitive. And that's exactly what happened. The Dow, the S&P, and the NASDAQ, and the Mag 7 all pierced their short-term trend lines, and boom, down we go. The Russell and the equal weight pierced their intermediate-term trend lines, and boom, down we go. And the transports, they were sitting right on top of both the short and intermediate trend lines that are converging. And so when it pierces one of those, it pierces both, and boom, down we go. And remember, they don't care. The momo guys don't care about PE ratios, discounted cash flows, or even the fundamentals. They don't care about what some strategist thinks the Fed's going to do, and they don't care. They just care about velocity. That's why prices fall fast. Sellers hit bids, buyers move over and step aside, and down we go. And yes, it gets uncomfortable. And this is where you've got to stay disciplined. Don't let them see the whites of your eyes. Hold your ground. Don't panic. Recall that April drawdown, right? You're a long-term investor, not a day trader. Remember, it's about time in the market, not timing the market. You have a quality portfolio. You planned for this. Time is on your side. Don't tip your hand. Let the momo guys exhaust themselves. Let the algos finish their tantrum. And then you act calmly, deliberately, and according to your plan. It's called stocks on sale. I mean, if you're willing to pay $258 for Amazon 2 weeks ago, the all-time high, then why would you run out the door when it's trading down 12% when nothing about the fundamental story has changed? In the pre-market, Amazon this morning is down another $3, trading at $229, just $1 above the trend line. So just sit back and just watch what happens. If it breaks that trend line, then $215 is not out of the question. And if that happens, that would represent a 17% decline off the high. That's called a sale. Now, the VIX, which was higher yesterday morning in the pre-market, shot higher after the opening, trading up as much as 18% before settling up 15% by the end of the day, which put pressure on stocks. This morning it was up another 5.5% early this morning, but has since settled back and is currently only up 3%, suggesting that maybe cooler heads will prevail, which doesn't mean we won't go lower. We most probably will. But what it means is if you're looking for a crash, I think you're going to be disappointed. So to be clear, so far this year, to be clear, the Dow, not this year, in this last couple of weeks, the Dow is down 3.7%. The S&P is down 4%. The Nasdaq's down 6%. The Russell's down 8%. The Transport's down 4%. The equal weight is down 4.25%. And the Mag 7 is down 6.2%. None of them are in correction territory, which doesn't mean individual names are not. In fact, Amazon is down 12%. Nvidia is down 12%. Palantir is down 18%. I mean, I can keep going, but all that means that there is opportunity for the long-term investor because these stocks are not blowing up. Bitcoin is trading at $92,000. That's down $38,000 or 30% from the all-time high that it reached a couple of months ago, and it's now in negative territory for the year. This morning it traded below $90,000 but has since rallied back. Many now asking, are we in a crypto winter? The talking heads say we are not. You have to do your own due diligence and see where you're comfortable. Gold is down $400 or 9% off its all-time high, leaving us still up 53% year to date. Oil is below $60 a barrel, trading at $55.90 this morning, down from $71 in July. Bonds are up. Yesterday, the TLT and TLH rose by 0.25%. Yields remain in a tight range. The 2 years yielding 3.57, the 10 years at 4.11, and the 30 years yielding 4.72. 30-year mortgages still are costing you 6.2%. 15-year mortgages are costing you 5.6%. And your government money market fund is paying you 3.7%. Now, it's a big week for retail earnings, and Home Depot reported and they disappointed, missing estimates, blaming homeowners for not fixing up their homes. It's trading down $6 or 1.6% in the pre-market. Watch for Walmart, Target, Lowe's, and more. And if the others mimic the Home Depot narrative, then it might be more of an issue. But Walmart and Target are two very different businesses than Home Depot, so I expect that to be a different story. Lowe's might have the same narrative, and that should not surprise you. Nvidia, well, that's tomorrow. And the bets are on. The options market, like I said, are pricing in a 90% chance of a substantial beat and then on their numbers, right? And they're pricing in a plus or minus 7% move after that announcement. Now, while Nvidia is up 41% year to date, they have taken 28% out of it over the last week. They pierced short-term trendline support. They tested intermediate trendline support at 178, which held. This morning it's quoted at down $2, 184.80. The media is making a big deal about the fact that Peter Thiel's hedge fund, Thiel Macro, sold all of their Nvidia, 537,742 shares worth over the past couple of months, raising $100 million, as if now everyone should panic because Petey sold his stock. Okay, you can run with that. Don't you really want to know where he bought it and did it meet his target? My guess is that he did just fine, and now he's looking for other opportunities. Remember, he is a hedge fund, not a mutual fund. They operate on different metrics. Recall, when Uncle Warren in the spring sold his Bank America stock at $40. Everyone thought, I need to sell my Bank America, right? Because Warren sold it. Nah, he bought the position at $5 during the great financial crisis, and the sale at $40 represented a 700% return. I'll take that any day of the week. And by the way, Bank America is now trading at $52 after trading at an all-time high of $54. U.S. futures this morning are down. Dow is down 260, S&P is down 20, Nasdaq down 100, Russell's down 8. The S&P closed at 66.72, down 61 points. We busted right through trendline support at 67.10 and are now in the 65.30, which is intermediate support, and 67.10, now resistance in that trading range. Once we broke support, the algos got more aggressive to see if the bulls would defend the position or if they would step aside and test the anxiety level. Well, they stepped aside, and it looks like they're going to step aside again today. Now, this could all be end of the month selling, right? Clean it out, flush it out as we prepare for a Santa Claus rally in December. Or maybe not. So sit tight. Do not make an emotional decision. because that's always the wrong one, right? Now is the time to stick to your plan. Now is the time to remain disciplined. Talk to your advisor if you're concerned. Patience is always a virtue, especially when the markets get nervous. Now, you can call me at 561-931-0190 to give you a no-obligation review of your portfolio, because it's all about risk management. Let me help you assess the risk of the portfolio versus the risk you think you're willing to take. Anyway, here's the countdown. Black Friday sales are already happening. In fact, Macy's announced a pre-Black Friday sale starting today, right around the corner from me. 22 days until the FOMC meeting, 37 days until Christmas, 43 days until New Year's Eve, and the ball in Times Square. Okay, so now what are we having for dinner tonight? Oh my God, this is so delicious. And there's a little bit of a story, so I'm going to tell you. It's Tuscan beef stew. It's called Tuscan beef Peposo. Peposo is a slow braised Tuscan beef stew made with beef shank or beef chuck, right? Lots of black pepper, whole peppercorns, and cracked pepper. You need red wine, Chianti's the classic. You need garlic, you need salt. That's it. No carrots, no celery, no onions, no garlic. It's peasant food at its best. The dish was created in like the 15th century in the town of Impruneta, just outside of Florence, famous for its terracotta kilns. All right? The tile workers would just toss chunks of beef and pepper and garlic and wine into the clay pots, then seal them, and then push the pots into the corner of the kiln overnight. The heat of the kiln would slowly melt the beef into this velvety texture, and then the pepper and wine combo created this deep, bold sauce, almost smoky and spicy and magically simple. Now, it's said to have been a favorite of Filippo Brunelleschi, the guy who built the dome on the famous Piazza del Duomo in Florence. Now, so here we go. For this, you need 3 pounds of beef shank or chuck. You cut it into large chunks. You need 6 to 8 cloves of garlic. Yes, you do need garlic in this one, just no celery, carrots, and onions. You're going to smash the garlic. You need 2 tablespoons of cracked black pepper. You need 1 tablespoon of whole black peppercorns, right? Kosher salt. You need a bottle of Chianti. And that's what you need, right? Now, you're going to brown the beef, season it with the salt in like a big Dutch oven, heat it with a splash of olive oil, and brown the beef on all sides. Don't rush this, because this is where it all begins. Now you're going to add in the garlic and the pepper. You're going to toss in the smashed garlic and the cracked pepper and the whole peppercorns and let them all come together for about 30 seconds or a minute or so. Now you're going to add the wine. It's probably a whole bottle. You want to pour enough Chianti in to cover the meat. And you scrape up the bottom of the brown bits before you cover it up. Now, bring it to a simmer, cover it, and cook it on the stovetop for 3 or 4 hours on low, or put it in the oven at 275 degrees for 3 hours. When it's done, the meat should melt when you touch it. Now, remove the lid, simmer it for another 15 to 20 minutes to kind of let it thicken up a bit and become glossy and rich and luxurious. Serve this, you can serve this over polenta or pappardelle, or you can just do a Tuscan style and just use crusty bread to just eat the beef and soak up the sauce. It is so delicious, and it is so Tuscan. In any event, it is another gorgeous day here in South Florida. It's going to be about 75 degrees and blue skies, absolutely stunning. Until tomorrow, take good care.